talk about on hedging effectiveness in current scenario. You know, since morning, even as the conference has been going on, I do understand that all of us have been talking about on what's happening in Iran, Israel's role in it, and of course, the statements that have been coming in from US as well. The latest that we understand is that most of the flights from India to Middle East have been suspended as of now. So whether it's about Doha, Abu Dhabi, Dubai, and various other countries as well. That is the kind of scenario that we are living in right now. And the latest, I was just reading on my phone right now that the US president will be talking to the nation in next few years, a few hours rather. So clearly the uncertainty does not die down at all. And at this point in time, with the kind of uncertain world that we are living with, whether it is about geopolitics, whether it's about trade tariffs, monetary policies, the kind of debt that the Western world is carrying, and the kind of moves that we are seeing in many of these commodities, hedging is important. The other thing that I was also talking about is on how when the prices are rising, do a lot of people hedge or they don't? What is the kind of percentage of businesses do they hedge? So this is like one of the very, very important conversations right now. Prices can do what they do, but how are you managing your business? Is the way to look at it. So we have a very, very esteemed panel here. We have exchanges, we have capital markets, and we'll try and tell you on what is the hedging looking like right now, and what is the future of that as well. Why don't we start with you, Shivanshu? Would you say that the numbers clearly seem to have been going higher? One, yes, people want to make use of the moving prices. Trade is higher than usual. You've been doing record volumes, turnover, etc. But would you say most part of that comes in from hedging?
Yes, very, very interesting. I think we need to take it to a slightly longer term horizon, maybe a year or so. One thing distinctly is that like you said, the risk premiums, because the risk has been macroeconomic, geopolitical, economic, and any other type, what you like to say. And I think it is reflecting in the way the options, especially on gold and silver, are reflecting higher participation, higher volumes, higher open interest. And in sort of tandem with futures, futures has also picked up in a very big way. If options has gone up 4 or 5 times, futures has also gone up by around, a healthy amount. We do about 50,000 crores of futures and 250,000 crores a day of options. So in all, about $35 billion a day. I think when I talk to the jeweler fraternity, especially the leading listed jewelers even, they tell me that we have adequate amounts of put option open interest to protect their inventories across the stores, to be flexible in their pricing. So definitely a large portion of this is hedging, if you were to call it. The other half being the retail participation, because we are seeing the 4th, 5th, and 6th month liquidity build up. That's a very new phenomenon in the smaller contracts. So very clearly SIP usage and hedging risk off on the other side.
Shivanshu, let us in on some numbers then. Is it the listed entities who hedge better, or is it the unlisted ones, traders, bullion? Who does it better?
I think, initially, if you were to talk 4 or 5 years back, you would find that as per the listing obligations, disclosures, it was the big people, the bigger jewelers. Then there has been a wave of jewelry industry IPOs. You've had the SME jewelry segment contribute, to the hedging volumes NOI. You also have a large fraternity of small regional pockets of the industry where we go with associations like IBJ and we conduct awareness programs. There also there is a tremendous, while there is an ever-moving target of awareness, I cannot say today that the awareness is where it needs to be, but it has grown over the years, especially when they face situations of domestic premium and discount, which is not really what it used to be at par. It may still be highly correlated, but there is a basis which comes in. So at those times when they start inquiring, then there is a learning. And when there is a learning in the business by way of margins, then there is a sort of a conscious move towards hedging. We do about...
But big jewelers, we understand, have treasuries. The smaller guys usually feel that, oh, I'll have to employ another person maybe I don't understand this so better. Do you think that learning curve is getting better?
No, absolutely. That is a challenge. There is a requirement, if you ask me, of people to understand hedging, the mechanisms, the complications it may or may not bring, or it may ease. So it calls for manpower. And people who don't have, there is a large member base that we have today. And those members have also evolved. They have corporate desks. They frequently go along and they talk to those audiences along with us at times. And I think they are playing that role for the smaller jewelers here.
What would you say is hedging more on the exchange, when the prices are going down, when they're going higher, or when they're very volatile?
I think in my experience from the base metals and bullion industry, all fabricators, whether it's a cable manufacturer or a jeweler, when the prices start moving up, there is a sudden surge in the hedging.
It is.
Yes. We have moved away from that traditional thought that anyway my inventory is going up in value. It's my family inventory. I'm a store of 10 kg or 20 kg gold.
I'm getting wealthier anyways.
I'm getting wealthy anyways. Now people have to account for books. They have to look at valuations. So therefore, risk management now, as on 31st March of this year, what is the valuation? That has come in. And the family setups are becoming more and more organized. So a lot of churning is happening.
Russell, let me come to you then. And what has been your sense on reading the market the way it is right now, given the fact that we are dealing with a very, very uncertain world? We don't know how the Monday markets will open. But within this scenario, one, how are you looking at the importance of hedging? And what is your sense? How have you read the pattern?
Sure. Good afternoon, everyone. Hedging, I think we should just quickly, what is a hedge? Not everybody knows what a hedge is. A hedge is, I could be a physical participant, someone who has physical assets, such as gold, sitting in a vault or in a refinery. And my business is not necessarily to be a trader. So all I want to do is I want to manage the price of my assets for my business. A good example is we always talk about airlines. I have to sell my tickets on a flight. I need to know how much my business is going to cost me. So I hedge the price of my jet fuel. It's exactly the same for a refinery or a jeweler or a bullion trader. So we have to think about why someone's hedging. That's the first element. The second bit is, how do I trade? So not everyone who's a hedger should be a trader. If I'm a refinery, I shouldn't necessarily be trading because it's a separate business. Many do, but you don't have to. So with that in mind, the prices and the way they move, what IIBX does is we try to create a price for an asset at a given time in a given place, but like exchanges do. The price of gold comes from many different places. If I buy gold in London versus New York versus Singapore versus India versus Dubai, they're different because of supply and demand, the macros, which is to your question. So what's going on in the world now, particularly today, and I suspect we'll see some price changes today and tomorrow, it comes down to a very simple thing called supply and demand. Supply and demand happens in all assets, commodities, and it's ultimately, does someone want that item more or less? And is it harder to get or easier to get? And that's pretty much it. So what's happening in the Middle East is also connected to something called macroeconomics, which is the price of oil is likely to get impacted. The dollars will get impacted, which obviously then becomes a safe haven for gold. So we expect to see more demand based on what's happening at the moment. But we've been in this situation for a couple of years now. Not everyone is as itchy as they have been before. So it's definitely something to watch over the next few days. And just lastly, everyone needs to be very educated on how the markets are correlated. So correlation is when something looks like something else or moves like something as we know it. Historically, gold and oil and interest rates have been very interlinked. I would probably say in the last year or two, especially with the US and some of our friends there, that's changed. And if you're a business managing a gold supply in any form, you should be very aware of what's causing that change and at what location that's happening. And just on a hedge, so one last thing, I got asked the question, why should I bother hedging if gold always goes up? Well, I would always remind people, Even if gold's going up, it can change. A few weeks ago, we went from 5,500 to 4,800 in 2 days. If you bought that move up and that price change, your business is going to struggle. So it's always worth thinking about that markets do go up and down, and that's where hedging becomes important. Hedging manages your business, it's not trading.
Oh, I get that point, Russell, but would you say that's a misconception? Not even a misconception. Maybe when your underlying commodity is just gaining in value, people don't tend to hedge a lot. Is that something that needs to be worked on?
It depends on the asset. So there's a big education that's happening in commodity markets. So financial markets such as interest rate futures, currencies, all these things have been getting hedged and managed since the 80s and 90s. But commodity markets are still very much looked after by bigger types of firms. So smaller companies haven't had asset access, which is something we've heard a lot today, and that is very relevant. The more people educate and get access to global markets, the more hedging will take place.
Point taken. Hitesh, I would want to come to you then. I'm trying to do the exchanges first here. What is your sense on how do you look at importance of hedging in the current given scenario?
Good afternoon, everyone.
Hitesh, the question is to Hitesh. I was trying to do the exchanges first.
That question was to me?
No, to me. Okay. So, good afternoon to all of you. Thank you, Manisha, for a wonderful question, and thank you to everyone. So, we need to actually understand the perspective of hedging. When we talk about the real world hedging, let me take an example and tell you what exactly it is, when, how much we need to execute it, and with which instrument we need to use and hedge it. The objective when we talk about hedging is risk management. In simple words, it is like I wish to concentrate on my business and don't want to speculate on prices. That's what we call it as the perspective behind the hedging. For example, I'm a bullion merchant, though I come from the exchange, so can't take the real example with the prices. So suppose I'm a bullion merchant, I plan to buy, in future. To execute a transaction, I buy the metal at a price of 100. A simple example. What is my risk? The risk is if the spot price goes down, that is going to hurt me. How I neutralizes my risk, which is decrease in prices, is by using the derivative instrument. The most popular one is the linear derivative, the futures, the simplest way to hedge my risk. So in case if the prices goes down, I have a position in futures contract, which is a sell position, a short position, which helps me to cover my losses arising out of my long position in cash or a spot market, okay, with futures. What is the ideal when we talk about, when we execute when we read a bookish example of hedging? If I lose 5 rupees in this example, in spot market, my gain from the futures should be equivalent to it. That's what we call it as a perfect hedge or an appropriate hedge, I will say. But in case of bullion, things are very, very different. You have risk pertaining to change in USD INR. You have risk pertaining to change in duty. And what we have seen in recent past is the premium over and above the landed cost, which makes the dynamics pertaining to hedging for bullion in Indian market a bit different. It's not as simple as what, when we talk about the other spectrum of commodity markets, talking about crude oil or other products, electricity futures and all. It's a bit complex because there are certain pointers which are non-predictable, unknown, and can't be defined in terms of risk. Or even if someone tries to define, it is not certain. So when we talk about hedging in Bullion markets in India, with very specific thing, number one, people need to understand the dynamics of instrument, which is futures first. Understand the futures. Number two, even a less 10% being hedged, instead of hedging your complete exposure, a less 10% hedge or an extra 10% hedge, just 10%, may change the market dynamics because you have an inbuilt component in India pricing, which is a premium over and above a landed cost. So we have to be very, very vigilant when we are using bullions in India as far as hedging is concerned. The second thing is, definitely, if an exposure is in USD terms, so currency derivatives are available, which also needs to be hedged. So a combination of commodity derivatives along with currency derivatives, if you are exposed towards forex risk as well, needs to be hedged. But we need to understand, because there are uncertain pointers to this, irrespective of the kind of volatility exist in the market, could be absolutely thin or extreme volatility, which we have seen in the recent past. It is always advised to be hedged, completely hedged. But you have to discount a fact that even if you're 100% hedged, even if you are using a statistical example to neutralize the exact impact of spot losses vis-a-vis futures, you are still going to have some plus or minus in the irrespective whether the volatility is less or more. Hedging is one of the finest things. The last point which I want to bring home here is options. Amazing instruments, but an amazing instrument for traders. But people who wants to use it should have to be proficient in understanding not just what is being written in the books, that you have a limited loss and an unlimited profit. That's good for passing few examinations pertaining to derivatives. But it's a complex instrument. People need to learn, understand, start practicing, and then to incorporate in their hedge policies. That's my view.
Wow, Hitesh, you almost took me back to my MBA days with case scenarios pointing out on how this really has to be done. But you know what? We need to be reminding ourselves yet again that it is an important part of business. You know, when I initially joined this industry, Hitesh, and I went to them telling them about futures and options and kaise hota hai, all of that, how that happens, Jota, Fatak, they knew it all. But the point being that coming to exchange and doing that was perhaps the newer part here. But coming back to the industry point of view then, and John, let me come to you with this one. When it comes to the jewelry market, and you guys are privy to numbers. So tell us on when it comes to jewelry as an industry, at what extent are they hedging? How much should they be hedging? And how do you as a brokerage look at companies who hedge better?
So we have to understand first that in a jewelry business, gold or silver, or especially gold, forms almost like 85 to 90% of the cost of goods sold. So the margins are relatively lower at around say 10% or 12%. Combine that with the inventory holding period. Generally, the time from procurement to sales would be somewhere around 3 to 4 months. So during that period, even if there's that short period of 4-5 months, if there's an adverse price movement of say 8 to 9%, today we are seeing it even 2% every day. So if it is say 8 to 5 or 10% over a period of 3-4 months, it actually erodes your margin. So you have no option but to hedge. So investors like earning predictability. They don't want this kind of price distortion impacting their profitability. So all the good companies, I will not say everyone, most of the good listed companies do hedge to the extent of 75 to 80%. There are companies which hedge to the extent of 90 as well.
So how do you look at companies who are just about hedging 10% vis-a-vis companies who are hedging 80 to 90%?
Sorry, come again?
How would you look at those companies which are hedging more?
How do we value?
Yeah.
See, again, investors look at this jewelry company as a consumer discretionary company. So with lower earnings volatility. So what they presume is that the margins are predictable. And not only the margins are predictable, And after that, all it boils down to the fact is that these companies get valued on the store expansion, the same store sales growth, return on capital employed, and the brand equity. Now, because of which these premium valuations are there for the companies which get hedged. Now, compare that with a company which is not hedged. Say there are few jewelry companies which are not hedged. Investors view that as a commodity company subject to inventory shocks. So in that case, they will get valued more or less closer to the commodity company. I'll give you certain examples. Most of the hedge companies, regional hedge jewelry companies, they trade at almost like 35 to 40 multiple 1 year forward. But when it comes to the unhedged companies, they trade at around 10 to 12 times. So both get valued, but one get valued as a consumer discretionary, the other get valued as a commodity company.
Okay, that's a very, very valid point put out. So if you are hedging more, then you're not just a commodity company, but you're taking your business more seriously vis-a-vis a company which is hedging lesser, are you saying?
Sorry, Kamal? I didn't get you.
I said the way that you look at companies, companies who is hedging more is seen as a high value company.
Yeah, obviously. Because as I told you, when you hedge, your earnings are predictable. It is not subject to price shocks.
Lokesh, what is your sense? Just taking a leaf out of what John just said, when it comes to hedging, how would you look at that? And you know, the other thing really was on the way the exchanges were raising margins because the volatility was just so higher. So some people thought that the whole value of hedging had gone up by many notches. This is a question I'll come to both of you as well, the cost of hedging really, but to you first.
First of all, good afternoon, everyone. Thank you, Ibja. Thank you, Manisha ji. So as sir said, like I'm sure like he's very much correct in this. And hedging is the fundamental of every bullion and every jeweler. And to save the inventory, they should apply this at cost. And when it comes to the margins hikes from the exchanges, it will affect the hedging options for the jeweler and bullion. But at the end of the time, they should keep it safe.
What would you say about hedging? You know, again, just coming back to that question to you as well. When the prices go down, is the hedging higher? Or when the prices are higher, is the hedging higher?
It depends on situations, you know. But at times when... can you just come to the question again, please?
When do you hedge better? Do you hedge as a principle? Or do you hedge when the prices are more volatile?
Hedging is the fundamental at the volatility time to save the inventory at cost, for sure.
All right. Simon, let me come to you. Samir, let me come to you now. This is a complete different thing that you're bringing into the markets as well. When it comes about, you know, as we were pointing out, when you hedge in Indian markets, it's about hedging forex risk as well. But the spot gold is another thing that you're working with right now. Talk to us about the logic of it and, of course, the benefit of that.
Yeah, so I mean, as a professional and as an individual, I think I'm the latest entrant here. And being an outsider, I've been working in the gold market for about 1.5 months, 2 months now. As an outsider, I come from capital market and taxation background, from the financial infrastructure background. And I am surprised to see that, you know, a lot of infrastructure is needed in the form of hedging, for hedging. So you need an exchange, you need instruments, but one of the primary thing that you need for to be able to hedge is the prices itself, spot prices. And there is absence in terms of you know, consensus on how you arrive at the prices. In fact, I was referring to SEBI's note, you know, on ETF gold valuation and silver valuation that they issued 2 days back. And there, if you see, they have written that you know, till now valuation has been on London AM prices, AM fix. And then on top of that, you add Indian vagaries in terms of taxation, in terms of you know, logistics cost, in terms of import cost, etc. I mean, these things, as an outsider, I feel these things should have been given. Okay, and there should have been a wider consensus on the spot prices. And what has happened is, I believe traditionally, MCX has been successful in terms of futures prices, and people have you know, started referring to COMEX and London prices, London fix, and looking at futures prices and backworking spot prices, whereas spot should have been the first thing.
Okay, so one of the things you would have seen in the morning with IBJA, we have formed an entity called IBJA IGM, and there we are trying to adopt to IOSCO principles of financial benchmark calculation, price calculation. And IBJA is doing a very good job now. Currently, they poll they poll for prices every morning. First is we are converting that into digital form, and then secondly, in the second phase, we will ask for traders and bullion merchants and everybody in the value chain to actually show their trading interest and actually trade on these prices. So every morning you will be able to, we will display you prices and you will be able to enter your trading interest. We will match and we will derive a mechanism where we also read the details of settlement, etc. So not only will these prices be indicative, they will be backed by actual transactions. And we are doing this for the community, bullion community, and I hope you guys will adopt it.
All right, so that's a spot benchmark price that we're talking about. But just coming back to the whole volatility and margin hikes, Russell, why don't you go first on this one? The prices were volatile. Hedging is important. Prices were going all over the place. And then the margin hikes were coming almost every second day. How does one hedge into that? How do you as an exchange look at markets like that?
So when prices move a lot, we call it volatility. The higher the volatility, then you obviously have to pay more margin to protect your position. The beauty of exchanges is your position is backed by the market, right? So as an exchange and a clearinghouse, we have a concept called a waterfall fund. So everyone puts money into that. It's like skin in the game. So therefore, your margin covers any default to a counterparty. So on an exchange, you don't have to worry about your counterparty because you face the exchange or the clearinghouse. In the spot market is very relevant still, and IIBX, we have a futures market in Singapore where we price the cost of kilobars in Singapore on a futures basis. But we're also connected to what we call IIBX Spot platform. So you can trade spot metal in the system in Singapore, in the Singapore tax regime. So if you keep it within the Singapore system, we have a Brinks fault, then there's no taxes. So it's a very efficient way to manage your futures market into your spot market. Spot markets in general, in commodity markets as a whole, have always been known as the primary market. So what is the price of spot? However, what's happened in the last couple of years with a lot of volatility is the futures market or the derivative market has become primary and spot has become secondary. So as someone who has exposure to a hedge, they really need to know what the cost of the futures market is because that will move first. Tomorrow morning, the market will move before anything does in the physical market. And the physical market, you have to rely on your counterparty to create a price for you. The futures market, whether it be on IIBX or MCX or COMEX or Thailand or wherever, these are prices of gold in a particular place at a particular time. So that gives you access to something with lower counterparty risk at the right place at the right time.
Would you also say, Russell, this was a very, very difficult and a different market because almost every day somebody or the other would talk, oh, India is working like this with a premium. COMEX was another level. London was trading at another price. Qatar and New York and Japan, every price came in starkly different. Earlier, it would be $0.50 at max. This time, it was $8 to $10 to $12 of a premium trading into markets.
We actually saw much bigger numbers than that. So historically, people trade this thing called the EFP. The EFP is the cost of London spot market versus COMEX or New York metal futures. That thing has been stable for a long time, maybe 60 cents, $1.50, something like that. Last year, we started to see that blow out to almost $60. So if people are doing these traditional hedges, which they do in many asset classes across commodities, I know what COMEX is, so I'm going to hedge on COMEX. But is that the right thing to do? Not anymore. There's many different functions where you should be looking at where these different arbitrages are. So this is still a hedge, but you're now educating yourself on where you need to buy metal or where you need to sell metal to.
Oh, yes. Shivanshu, this one is to you. There was a point we were all talking about on when you have a 30% margin to be paid for gold and 70% for silver, why do you want to trade in futures? Why not just buy physical? But do you think you were basically just about doing what you were doing was managing risk?
Yes, absolutely. Margins are for the protection of the markets from both buyers and sellers. And while they may have been, it's very important to say this, that there may have been points in time from October to January and then to February, when international markets and domestic markets, first there was a backwardation, huge backwardation in silver. There was a scarcity of metal. And what we were just talking about, the EFP, we saw a huge movement towards US stocks, 19,000 tons. And then we saw scarcity all over the world. And then things started moving the other way around. Then there was a contango in the early part of January. And then came the Indian budget, pre-budget. And then there was some other inbuilds which took place. And people, at all those points in time, every delivery that MCX had, this is what is called spot to futures integration. If there is a seller, there is a buyer in the front.
Did you at any point in time?
Every delivery was successful, and in February,
I get that. Thank you.
We had 5.5 tons of delivery in February contract, which is all-time record.
Shivanshu, did you?
Coming to the margins. I'm coming to
I just want to have a follow-up question on that one. Did at any point in time, did the industry come and ask you on why the margins are going by this much and why at this particular time, why not earlier or later?
Yeah. So coming to margins, very valid concern because the hedger's working capital requirement goes up. It affects the amount the smaller to medium jewelers are able to hedge. We empathize with that. It's not we who decide the way the margins are calculated on our own. There is a method to it. There is a VAR-based calculation which decides an initial margin. An initial margin, you can't erase what has happened on the 30th of January from that formula by wish or by desire. And there is a method why it is like that. You saw crude oil a few years back went negative in price. So while there's a lookout period, then there are certain other statistical things which come in terms of risk, which are there. But then, as you're aware that post that, when things were brought to the right attention, etc., there's been a consultancy paper issued, regulatory paper, which is specific to this aspect of margining. Very, very positive move. People have responded to that, and it has closed something like day before yesterday. So as far as the additional margins which were in place are concerned, in both gold and silver, they were rationalized. Now only the initial margin in gold right now, all things said and done, is about 18%. Internationally also margins have gone up. So this is the way the margins are there. As far as the polled spot prices, as Samir was saying, just the fact is that ETFs have been, subject of a lot of attention from this very time period. That when we are benchmarking something on international prices, and that is not a price devoid of custom duty, and it's also a landed price. It was also a landed price-based formula, which has now been changed to polled domestic exchange spot prices. So the ETF, the movements in the ETF were being, whether they are in sync with what is happening was a question mark. And everything is done in the interest of the ultimate investor. And now they have been moved to the polled domestic spot prices. That's what has happened. And I think, sooner or later, the margins and the method behind that, what we're talking about, is only going to become more and more efficient as we go along.
Thank you for that. I'll just take a couple of minutes more. I just want to come to each one of you and understand what is it that in hedging that you would wish would move forward smoother? Russell, trading on exchanges, well, yes, there's a lot of complex stuff that you guys have to do. But when it comes to hedging world over, and because there are just too many complexities, it's not like a regional equity market. Commodities are huge in that way. What is it that you think would work better going forward when it comes to hedging?
Participation. The more people that take part, the more the liquidity will be there. And the more liquidity you have, the easier it is for you to hedge. So there's a lot of people out there in commodity markets, not just in gold, but in many markets where they don't have access to that tool to manage their portfolio. And when I mean portfolio, it's literally, if I've got gold that I need to make some jewelry, I want to know what I'm going to sell that jewelry for. If I buy gold at 5,500 and suddenly it's 4,800, it's going to be very difficult for me to sell my product. So it's just participation for me.
You know, I was talking to some of the participants on the exchange, and they said, yes, we are open till 12 in the night. Maybe we should start working at 6 a.m. in the morning for better hedging. I don't know what you think about that, but Lokesh, what do you think is better way of moving ahead from here when it comes to hedging? One thing that you would want companies to do better, exchanges to do better, or even regulator for that matter, something that you would want to put forth?
I urge exchanges to, to encourage people to move towards hedging. That is the main thing like people can do. And what I urge the jewelers and the bullionaires is to move from a typical Lalaji to CEO. So that would help them to maintain their inventories very well, and also just help them to keep up the help in the volatility.
From my side, so I don't go into the operational side of hedging. So what we only look at is that whether companies do hedge. Yes, we do talk with them what is the cost of hedging, because you always have to maintain a team also for that. Yes, there are difficulties to it, but ultimately the benefits that you get out of hedging far outweighs the cost and the efforts that you take. But in terms of operational, I would not be a correct person to comment on it.
Thank you for that.
Just to add what the other panelists said, there's a trade-off which was going on, still continuing, between the amount of margin required to hedge your position versus the volatility. The simplest way to understand the perspective is ask a question to yourself. Even if the margins are quite higher, are you ready to expose yourself to the risk? The kind of risk which we have seen last month. If you get an answer to it, hedge yourself completely. I'm sure my message is conveyed, wherein do remember the exchanges are platform providers. We try to cover the risk associated with price fluctuations, which can happen in one day to someone, which is called as worst case scenario. And if the worst case scenario goes further worse, we have to increase margins. That's what the perspective. Thank you.
Final comments from you, Samir?
I think clearly for me, adoption of technology, because the more I'm getting into it, I understand that equities derivatives, for example, as asset classes, have seen a lot of adoption of technology. Here in this domain, there is a lot of human intervention in terms of perception, prices, and people still talk over the phone, etc. So clearly, adoption of technologies, there is a huge way to go forward.
Thank you, panelists. Well, let me tell you that in an hour and a half, the US president is going to talk about Iran and Israel. And I really do hope that all of you are aptly and enough hedged in the markets there. Thank you so much, panelists, for being in here. Thank you for your time.